Breaking news on the economy. At any moment now, the Federal Reserve is expected to raise interest rates for the sixth time this year.
The Fed's goal to tamp down inflation, which is now at a 40-year high. The markets are expecting another 0.75 of a percentage point increase. That would be the fourth rate hike at that level so far this year.
So what happens when the Federal Reserve raises interest rates? Well, everything you pay interest on goes up. We're talking about credit card bills. We're talking about car loans and, of course, new mortgages as well.
Let's bring in NBC News business and data reporter Brian Chung. Brian, do we have that number yet or expectations?
We do, Kate. The Federal Reserve has officially raised interest rates by 0.75 percentage points, again, largely as expected. That takes short-term borrowing costs as targeted by the nation's central bank to the neighborhood of 3.25% to 4%. That, by the way, is the highest that we've seen since 2008. Again, all of this to try to make borrowing costs more expensive, to take down the pace of economic activity, to hopefully lower that above 8% year-over-year inflation that all Americans are observing on a day-to-day basis. The Federal Reserve, in their statement released just 2 minutes ago, noting that there's modest growth in spending and production, but said that the unemployment rate has at least remained low, again, referring to the 3.5% unemployment rate that is essentially near levels we haven't seen in about 50 years. But they noted that Russia's war against Ukraine continues to have hardship, making the challenge for the Federal Reserve on inflation that much more challenging.
Brian, there's been a fair amount of reporting over the years about the fact that oftentimes it can take somewhere between 6 and 9 months for the economy to feel the effects of an interest rate hike or an interest rate reduction. Do we know at this point whether what the Fed has done so far is working?
Craig, that's an important question that you raise. And again, you even have some estimates that say it could take as long as a full year for the impact of these Fed rate hikes to take speed. Now, of course, remember, the Federal Reserve hasn't begun the process of raising interest rates until about March of this year, which means we might not see the impact of the Fed's first rate hikes this year until perhaps the first quarter of next year. So that's something that really gives the Federal Reserve some pause, which is a reason why we have some chatter, maybe the Fed at some point wanting to make these interest rate increases a little bit smaller, perhaps to 0.5 percentage point or 1/4 percentage point. That might begin the process next meeting in December. You want to land this plane on the tarmac not at full speed. You want to soften it. But when that happens, is a very difficult task for Fed Chair Jay Powell, who will speak, by the way, in about 25 minutes. We'll see if he has any extra commentary to add on that front.
Thanks for watching our YouTube channel. Follow today's top stories and breaking news by downloading the NBC News app.